Hello, friends. Hello, and welcome to Unacademy, India's largest online learning platform. And welcome to my session today on the Limited Liability Partnership Act 2008, Part 2. Now, why do I call it Part 2? I call it Part 2 simply because I completed Part 1 yesterday evening. And thanks for the people who attended it. And for the people who did not attend the Part 1 session, I will have a quick recap, which you can recollect whatever we discussed yesterday in the Limited Liability Partnership Act 2008, Part 1. Now, like I said, I welcome you to Unacademy, India's largest online learning platform, and they have started a new vertical called Crack CA Exams with us, wherein we help you in your preparations for the CA Foundation, Intermediate, and Final level, and so that you can prepare seamlessly for your exam preparation. Firstly, am I audible and visible to all the participants? Can I have a thumbs up if you can hear me and see me clearly? A brief introduction about myself. Hi Shiv, hi Ritija, welcome to my session. I'm Prathik Gupta. I'm a Bachelor of Commerce from Christ College, Bangalore University. I am an Associate Member of the Institute of Chartered Accountants of India, an Associate Member of the Institute of Company Secretaries of India, an Associate Member of the Institute of Cost Accountants of India, and also a law graduate from Karnataka State Law University. Currently in the practice of chartered accountancy and also a visiting faculty for CA subjects and a tutor to CA students both offline and online. Prior to starting my practice, I worked with SR Barkley Boy and Associates, that is the Indian member firm of Ernst & Young Global. Post that, I worked with Ernst & Young in the mergers and acquisition department, and then I had a brief stay in the Manipal Group, wherein I was the corporate controller of their Indian and German entity. So that's a brief introduction about myself. So I welcome you all to the session today. Now, what do you get when you enroll to the Unacademy platform? You get daily live classes where you get to chat with your educator, engage in discussions, ask your doubts, and answer polls all while the class is going on. You also get live tests and quizzes which evaluate your preparation with our regular mock tests and quizzes and get detailed analysis of your performance so that you can identify your weak areas and improve them as and when you want. You get structured courses. You get structured courses as part of the Unacademy platform where all the chapters are structured in such a way that you get to do your step-by-step preparation and no point is missed out, so that your preparation is comprehensive and complete. And most importantly, you get unlimited access to all the resources and courses on the Unacademy platform, which you can avail at any time of the day as per your convenience. So for the people who have not yet downloaded the Unacademy Learning app, I request you to download the Unacademy Learning app from the Play Store. It's quite simple. You just need to enter your mobile number and an OTP and you're registered on it. So the people who have not done it, I request you to do it. Thank you so much. Hi Niyanti, hi Aditi, thanks for joining in. The Unacademy provides various subscription packages for the various courses. For the CA Foundation and Intermediate subscription, the packages are 1 month, 3 month, 6 month, 12 months, and 24 months. And the rates for those packages are given to you on your screen. So I request you to choose your package, and while choosing please do not forget to use the code Prathik, Prathik, to get a discount of 10% on your package price. All right, so let's do a quick recap of what we missed yesterday or what we did yesterday. So yesterday we spoke about Limited Liability Partnership Act 2008. As I said, I will be a little quick on the recap part, so please bear with me. Hi Sumit, how are you? Hi Priyanka, welcome to my session. All right. So firstly, what do we do? Yeah, introduction. The Ministry of the Limited Liability Partnership Act came into existence in 2008. Earlier to this, the Limited Liability Partnership Act, we had the Indian Partnership Act 1932, which covered the regulations related to unregistered partnership firms. So the biggest drawback of unregistered or partnership firms under the Indian Partnership Act 1932 was that they carried unlimited liability for its partners, and that was a huge risk. To overcome this problem, the Limited Liability Partnership Act 2008 was introduced in the year 2008. And like I said, there is a similar concept in the United States of America and other countries called the LLC, Limited Liability Corporation, from which this act was influenced and brought into India as well. Well, it's a good thing because it is advantageous for the people who want to run their business in a partnership model. All right, the LLP Act has 81 sections and 4 schedules. Like I said yesterday, the first schedule deals with the rights and duties of partners with the firm and among themselves and the relationship between themselves, whereas the second schedule deals with the conversion of a firm, that is a normal partnership firm, into an LLP. The third schedule deals with conversion of a private limited company into LLP. The fourth schedule deals with the conversion of unlisted companies into LLP. So for the foundation, CA foundation and intermediate level, the 3 schedules, the second, third and fourth schedule right now is not important. So we will not be discussing about that, but we will be focusing on the first schedule. So, hi Bhavik. So if anyone has any questions during the presentation, please feel free to ask me. All right, limited liability partnership meaning and concept. Like I told you earlier, it is a new concept which was started in the year 2008. Prior to that, we had the Indian Partnership Act 1932, wherein we dealt with the traditional partnership firms. So, like in Indian partnership, under the Indian Partnership Act 1932, the partnership deed was the utmost important document, whereas in a limited liability partnership, the utmost document is the partnership agreement. So the partnership agreement becomes of utmost value in a limited liability partnership as it contains all the details. It contains all the details like the name of the firm, the business of the firm, the registered address of the firm, the names and addresses of the partners, the PAN numbers of the partners, the profit sharing ratio of the partners, the roles, responsibilities, liabilities of all the partners. So all that is contained in the partnership deed. Partnership agreement. Similar document was a partnership deed, which was in the Indian Partnership Act 1932. Okay. Now, like I explained yesterday, now LLP has borrowed 2 concepts. When I say LLP, it is limited liability partnership. The LLP has borrowed 2 concepts. One concept of limited liability from private limited companies, that is the corporate structure, and one concept of flexibility from the traditional partnerships. So from now on, whenever I say traditional partnerships, please remember it is a partnership firm which was started under the Indian Partnership Act 1932. So LLP means limited liability partnership. Traditional partnership means a partnership firm which was started under the Indian Partnership Act 1932. And yeah, for right now, those are the 2 short forms I will be using. All right. So the traditional partnership firms are very flexible in terms of the internal management, in terms of how the compliances that need to be done. Everything is within the control of the owners, that is the partners of the firm, and there is not much government intervention, or there is not much filings that need to be done with the government. So a similar concept was used in the LLPs, wherein the amount of intervention of the government or regulatory authorities or external people was minimum. I wouldn't say 0, but it was minimum, because a few forms still need to be filed with the MCA. All right. And at the same time, the limited liability concept, like I told you yesterday, the limited liability means the liability of the partners is limited. It's limited to the extent of commitment made by them in the partnership agreement. Let me give you a quick example for the people who missed. Hi, Hansika, Disha, welcome to my session. All right. So, yeah. Where was I? Yes. So, so let's take, for example, we have a traditional partnership, and A and B were partners in that firm. So the firm bought materials, the raw materials from C, worth 6 lakhs. So they bought it and everything was going on well, but suddenly the business of the firm went down. There was no more business of the firm. In such a case, what happens? So A and B and the partnership firm was unable to pay money to C, the 6 lakh that they owed him. In this case, what is the remedy C had? So C requested them for the money for a long time, but because A and B did not pay the money, he went and filed a case in the court. When C filed a case in the court asked the partnership firm of A and B to pay the money. When the partnership firm did not have enough money in their bank account to pay C, what happened? The court ordered A and B to pay the money to C from their personal assets. By personal assets, I mean by selling off maybe their house, by selling off their car, by breaking their FDs, or any other investments they had, the court ordered A and B to pay C. Now, this is a prime example of unlimited liability. So if you see in this case, A and B had unlimited liability. That is, if the traditional partnership firm is unable to pay the debts to the outside parties, then in that case, the personal assets of the partners can be attached to be used to pay the outside parties. Now, this was a major drawback of a traditional partnership. So what happened? Now, to avoid or overcome this situation, the government took the concept of limited liability. Now, okay, now let me explain the concept of limited liability to you. Now, let's again take the example of A and B. They run a partnership firm and they bought goods from C worth 6 lakhs. Now, let's change the scenario a little to explain things to you. All right, so when that happened, what was I saying? Yes, when that happened, now let's assume that both of them have limited liability. So the C went to court and said, I want my money of 6 lakhs. And the court said, the partnership firm, please pay the money to him. But when the partnership firm did not have the money, the court asked A and B to pay the money to C. Now, how much of money do A and B have to pay C? A and B have to, now in case of unlimited liability, they have to sell their own personal assets and pay it to C. But in the case of limited liability, their liability will be limited only to the extent they commit to pay in the partnership deed or partnership agreement. So let's say in the partnership deed or partnership agreement, A and B said, we will pay 1 lakh. Our capital contribution is 1 lakh and we will not pay more than that. In that case, their liability is limited to a max of 1 lakh and not more than 1 lakh. Did you understand the difference between limited liability and unlimited liability? In case anyone has a question, please ask me, because this concept of limited liability is also important for the next session. That's Companies Act 2013. Any questions, please ask me. Okay, so then the government took the concept of limited liabilities from private limited companies and flexibility from traditional partnerships, combined both, and that's how you got the Limited Liability Act 2008. Any questions so far? And that is why a limited liability is called a hybrid between a company and a traditional partnership. What do you mean by hybrid? Hybrid simply means a combination or something that has qualities of both. So a LLP has qualities of a private limited company, which is limited liability, and it has qualities of a traditional partnership, which is the flexibility in running. So that's how an LLP comes into existence. Okay, am I too fast? Is my speed okay, or should I slow down? Can I have a feedback, please? Or is it okay? Should I continue like this? I request all of you to respond. Thanks, Rutija. I request the others to respond as well. Thanks, Aditi. Thanks for your response. So I presume my speed is okay. I'm not too fast. So I shall continue with this. I hope you're able to follow what I'm saying. Yes? Okay. Now, let's go quickly run through the salient features or characteristics of LLPs. What are the salient features and characteristics of LLPs? Firstly, like I said, limited liability of partners. They are not supposed to pay more than what they have committed in the partnership agreement. Flexible form of organization. I have already explained this earlier. A traditional partnership is very flexible in terms of taking its own decision, internal management, and minimum government or external intervention. Administration according to LLP agreement. A traditional partnership firm had a mother document called a partnership deed, whereas a LLP has a mother document which is called the LLP agreement. Now, the one main difference between a traditional partnership and a LLP is an LLP is required to register with the ROC. By ROC, I mean the Registrar of Companies. He is a Registrar of Companies is an entity which comes under the MCA, which is Ministry of Corporate Affairs, which is responsible for collecting and collating all the documents and records relating to private limited companies, public limited companies, and now limited liability partnerships as well. So for an LLP to come into existence, it has to be mandatory registered with the ROC under the MCA. LLP agreement is the main document, like I said. Hi Yash, welcome to my session. LLP agreement is the main document. So like a partnership deed is an important document in a traditional partnership, an LLP agreement is an important document for the LLP. The economic rights of partners are freely transferable. Please remember, now this is another important point. Now, in a traditional partnership, if there were two partners holding 50% profits each, then either of the partners cannot transfer his share, 50% share in the company, in the firm, to an external person without the consent of the first person. So he cannot do that. If he does that, the firm is dissolved, or the first partner can take legal action against him. But in the case of an LLP, if there are two partners holding 50% share each, they can transfer their share to anyone they want. It is absolutely their will. All right, perpetual succession. Now, please pay attention to the term perpetual succession as well, because that is going to hold good when we do Companies Act 2013 as well. Perpetual succession simply means once an LLP is into existence, then the partners, hi Yash, good afternoon, I hope you're doing well. The partners come and go. There might be partners who are admitted, there are partners who retire, there are partners who die. But that does not mean that the LLP comes to an end. The LLP will come to an end only when it is officially dissolved and wound up, not before that. So we need to be careful about what that is. All right. All right. So separate legal entity. Again, let me quickly explain this to you. Now, partner A and partner B are two different people and two separate entities. They come together and they start an LLP, AB and Co. Once they start an LLP, AB and Co also becomes a separate legal entity with a separate PAN card and a separate document, and it needs to file its separate records. So when A and B come together and form AB and Co, another legal entity comes into existence, that's called AB and Co. All right. So there are three entities that come into existence there. Every partner is an agent of the LLP but not liable for the wrongful acts of the partners. Now, please remember, if an LLP has maybe 3 partners or 4 partners or 5 partners, then every partner is an agent of only the LLP. He cannot bind the other partners due to his wrongful acts. But in case he does any acts in the normal course of business to bind the LLP, then the other partners are bound as well. Or if he does any act fraudulently in that case. All right. So every partner is an agent of the LLP, but not liable for the wrongful acts of other partners. In the absence of any provision for distribution of profits, losses, partners are entitled to share profits and losses equally. Like I told you, the important or the utmost important document in an LLP is the partnership agreement. It contains all details of the partners, their profit sharing ratio, their addresses. So if the partnership deed or partnership agreement is silent about the profit sharing or loss sharing ratio of the partners, then it is assumed that all the partners share the profits and losses of the LLP equally. So if there are 3 partners, it will be 33.33%. If there are 2 partners, it will be 50% each. If there are 4 partners, it will be 25% each. If there are 5 partners, it will be 20% each. So this again is determined by the LLP agreement. So if there is any profit sharing mentioned in the LLP agreement, then it will be as per the LLP agreement. If there is no profit sharing mentioned in the LLP agreement, then it will be equally shared between the partners. LLPs are not allowed to compete as a not-for-profit organization. Now, not-for-profit organizations are organizations that are created for charitable purposes. Charitable purposes like education to the poor society, relief to the poor society. Now, in terms of COVID, at the times of COVID, there are a lot of not-for-profit organizations that have come ahead to help the people. So an LLP is expressly not allowed to operate as a not-for-profit organization, and not-for-profit organizations normally are Section 8, Section 12 companies or trusts. They operate as not-for-profit organizations, and limited liability partnerships cannot function as not-for-profit organizations. Am I clear so far? I request you to take about 30 seconds, go through the slide and ask me any questions you have. I will be happy to answer. I request all the participants to do that. Any questions, please ask me. In case no question, can we proceed? Okay, now quickly Hi Babulal, how are you? Quickly, let's go through the advantages of LLPs. LLP provides flexibility without imposing detailed legal and procedural requirements. I've already explained this point to you. It is flexible. It takes this quality from traditional partnerships. Is organized and operates on the basis of an agreement. The partnership agreement or the LLP agreement is the prime document in case of limited liability partnership, which contains all the important information pertaining to that LLP. An LLP is easy to form. Yes, it is relatively easy to form than a private limited company. All partners enjoy limited liability. All partners enjoy limited liability. Like I explained to you, limited liability means that their liability is limited to whatever they commit in the partnership document and not more than that. All partners, and then it involves a flexible capital structure. All partners are free to introduce capital into the LLP whenever they want. So an LLP gives you the flexibility of a traditional partnership in terms of flexible capital structure as well. And lastly, it is easy to dissolve. An LLP is easy to dissolve by you can apply to the court or tribunal for dissolution, and then you can or you can apply to the ROC or this thing for winding up, and it can be dissolved. So there are not many complicated procedures for the same. Any more questions? Any questions on this? Please ask, or else we'll proceed. All right. The extent and limitations of LLP and partners. Partner as the agent of the LLP and not of the partners. Like I told you earlier, every partner of an LLP is an agent of the LLP and works on behalf of the LLP, not on behalf of the other partners. So he cannot bind the other partners through his actions. LLP is not bound to act with partners, but and has no other authority to act for the LLP. Hi. Hello to someone named as Narendra Modi. How are you? I am good. I hope you are doing good too. All right. LLP is liable if a partner is liable to any person as a result of wrongful act or omission on the course of business. Like I told you earlier, if any partner does any act in the course of normal business and binds the LLP to it, then the other partners, the other partners of the LLP or the LLP firm incurs any losses, then that partner who was negligent or who did the wrong act is liable to make good the losses to the other person and the LLP. The obligations of LLP shall be solely obligations of LLP and not the partners. Yes, like I said, an LLP is a distinct, separate legal distinct identity. So the LLP's obligations are the LLP's and not of the partners, simply because the partners have a limited liability. A partner is not personally liable directly or indirectly to any obligation of the limited liability partnership, whether arising in the contract or otherwise. Again, this talks about the liability of the partners being limited and not unlimited. All right. Any questions? Please ask me. Okay, I'll quickly go through this slide as well. Now, in case there is if any of the partners do a fraud while working in the LLP or on behalf of the LLP, then the liability of the partners becomes unlimited and they can no longer claim it to be limited. This is one exception to the rule that the liability of the partners is limited. In case the partners commit a fraud while working, while binding the LLP to the external parties or internally, in that case, the liability of the partners becomes unlimited. Now we start off with today's session. How is it, or why is it important, or how do we incorporate an LLP? So please remember, the LLPs have come under the ambit of ROC and the MCA. So they have to file a certain number of documents, certain information with the ROC under the Ministry of Corporate Affairs. So what are those documents and how does the incorporation happen? Let's talk about that. Before I get into the slide, let me give you a brief background of how it practically happens. There are a lot of documents and forms that need to be filled and filed with the MCA. And during the incorporation of an LLP, the help of a professional in terms of a CA, a CS, a CWA is required, who certify those forms and upload it in the MCA portal. All right. So what are the documents that need to be uploaded? First and foremost, the document that needs to go is the LLP agreement. The LLP agreement is a document, is a comprehensive document which contains all the information about the LLP, proposed LLP, that is the name, the registered address, the additional place of business of the LLP, the names and addresses of the partners, the profit sharing and loss sharing of the partners, the capital contribution of each partners, the bank operating authority, the rules, regulations, roles, responsibilities, and liabilities of each partner, and how are they supposed to work internally. When I say internally, it means when a person is admitted into partnership or when a person leaves the partnership, how the settlement happens or how does the admission happen. So all the internal rules of the LLP is contained in the LLP agreement, which is a prime document. So we need to put that. Then there is something called as a DPIN. DPIN stands for Designated Partner Identification Number. So every person who wants to be a partner in a LLP needs to obtain a DPIN. And how do we obtain the DPIN? The DPIN, there is a form in the MCA. MCA is Ministry of Corporate Affairs, which you need to fill up. In that, they ask you for your PAN number, your Aadhaar number, your photograph, your date of birth, your address, and you're supposed to put in the person's address proof in terms of his bank statement, his passport copy, or whatever gives his current and permanent address. All those have to be put in. And that form also has to be certified by a professional. And once the professional certifies that form that he has checked all the information in that form is uploaded into the MCA website. Once the ROC examines the form and finds all the information in order, he generates a number called as a DPIN, that is a Designated Partner Identification Number, to the person who proposes to be a partner in an LLP. Please remember, a person can have only one DPIN. He cannot generate a second DPIN unless and until he cancels and surrenders the first DPIN. So there may be cases when people have two DPINs, but remember, you can have just one DPIN and not more than one DPIN. All right, so every partner who wants to be a partner in an LLP gets a DPIN. So that's the first step. Next step, what do? There is something called as name availability. Now, please remember, because the Incorporation of LLPs come under ROC or Ministry of Corporate Affairs. Ministry of Corporate Affairs contains the entire thing or regulates the entire thing in India. So when we need to apply for an incorporation of an LLP, we need to check for the name availability. The name should not be similar or same with an existing LLP, and it should not contain prohibited terminologies like crown, prince, government, state government, central government, and things like that. So there are certain names that are prohibited, so the name should not be that. So and the name of an LLP should always end with LLP. For example, if it's AB and Co, it should be AB and Co LLP. LLP stands for Limited Liability Partnership. So what happens now? The partners who want to start a LLP, they get the DPIN. Okay. Then they also need to get the digital signatures. Then the next thing what they need to do is they need to apply for name availability. So then they go ahead and apply in the MCA portal for a name availability. Let's say they say AB and Co LLP. And normally when you apply for your name availability, you're supposed to give 6 names in order of preference, so that when the ROC is scrutinizing the form, whichever name is available, he can allot that name to you. So let's say you give 6 names in preference: AB and Co, CD and Co, EF and Co, XY and Co, and 6 names, and the form is submitted. So then it takes about a week's time or maybe 3 or 4 days time. The ROC scrutinizes the form and then comes back with the name availability. Out of those 6 names, he tells you which name is available. And if no name is available out of those 6, he will send back the form and say no name is available. Please send 6 more names. So in that case, you're supposed to send 6 more names in the number of days they've given you to submit that form. So finally, what happens? Finally, okay, you send 6 more names, and one of the names, let's say Ankit Kumar and Co, is approved by MCA. So then the MCA replies and tells you that, okay, the Ankit Kumar and Co is approved, you can use this name. Now what do? That name approval will remain valid for you for about 30 days since the time ROC approves it. Now, using the name Ankit Kumar and Co LLP, you prepare your LLP agreement. So in the LLP agreement, you will say the name of the LLP is Ankit Kumar and Co. LLP. The registered office is so and so. The partners are so and so. The profit sharing ratio is so and so, and everything. You prepare the LLP agreement. Then along with the LLP agreement, there are certain proofs that need to be uploaded. You upload those proofs and declarations, attach it with the form, and you submit it to the ROC for verification. Now, please remember, this form also will have to be certified by a professional, and without a professional certification, LLP cannot be incorporated. So again, the professional also scrutinizes your entire form, looks at what details you have entered, and checks everything, checks for documentation, and in the end takes responsibility for the accuracy of the information contained in the form and submits the form. So even the submission of the form has to be done by a professional. No other person can do that. So then the documents and the form goes to the ROC, and if the ROC finds everything in order, he again scrutinizes it. It takes about maybe a week's time. He scrutinizes everything, and if everything is found in order, the ROC confirms that the registration or the incorporation of the LLP and sends you a certificate of incorporation. This certificate of incorporation is raised under the seal of the Ministry of Corporate Affairs and the respective ROC of the state where you belong, or where the registered office of the LLP is proposed to be situated. And this certificate of incorporation is the utmost proof that all the legal formalities regarding the incorporation of your LLP are complete, and nothing more needs to be done in terms of incorporation. But at the same time, if the ROC feels that there are certain documents that are missed, or if certain documents are incomplete, he can always send back the form to you and say, please complete or provide these details and submit the form again. Also, please remember, right from applying for your name to applying for the DPIN to applying for the incorporation of the company, there is a fee payable to MCA, which depends on what form is being submitted. And while you submit the form, that fee needs to be paid to MCA, and it can be paid either through offline mode in the challan, that is the MCA or local office, or it can be paid online using debit card, credit card, or internet banking. So that is in a nutshell about the incorporation of an LLP. Now let's go through the details provided in the slide. Two or more persons associated for carrying out a lawful business with a view to profit shall subscribe the names to the incorporation document. This is, like I said, the definition of partnership firm is when two or more people come together to carry on a common business and share the profits of that business, when the business is carried on by all or one of them on behalf of all. All right. The incorporation document shall be filed in such manner and with such fees as may be prescribed with the registrar of the state in which the registered office of the LLP is situated. I have mentioned this. When you submit your form for LLP incorporation, you're supposed to pay a fee as well, and that will depend on the state as well as the form which you are submitting. Statement to be filed. There shall be filed along with the incorporation document a statement in the prescribed form made by either an advocate or a company secretary or chartered accountant or a cost accountant who's engaged in the formation of the LLP, by anyone who has subscribed the name to the incorporation document. I have explained this point to you as well, that whenever you submit the form for incorporation, it's called a statement, and the people subscribing their names to the incorporation document, that is the partnership LLP agreement as partners, as well as the professional who's helping you out in incorporating the LLP, have to sign the form and then submit it. Without their signatures and without their verification, the form cannot be submitted. I have already explained this point. Take about 20 seconds, go through the slide and ask me if you have any questions. Then we will proceed. Any questions, please ask. Okay, now let me ask you a question. To all the viewers, to all the participants, please explain the difference between a traditional partnership and an LLP. Give me the difference. Please type out your answers. Any questions or any answers? Okay. In respect of incorporation, okay, now the incorporation document shall be in a form as may be prescribed, shall state the name of the LLP, shall state the proposed business of the LLP, state the address of the registered office of the LLP, state the name and address of each of the persons who are to be partners of the LLP on incorporation, state the name and address of the person who are to be designated partners of the LLP, contain such other information concerning the proposed LLP as may be prescribed. I have already discussed this, but just to recollect, the LLP document or the LLP agreement shall contain all this information, that is the state the name of the LLP, the proposed business of the LLP, state the address of the registered office of the LLP, name and address of each of the persons who are planning to become partners of the LLP, state the name and address of the persons who are designated partners of the LLP. Please remember, whenever an LLP is to be incorporated, out of all the partners, at least a minimum of 2 people are to be termed as designated partners. Designated partners are the partners who are responsible for running of the LLP and taking care of all the compliances. So let's say if there are 5 partners, out of the 5 partners, 2 of them have to be designated as designated partners. So the partners among themselves can decide on who is the designated partners, and the other 3 can be normal partners. Contain such other information concerning the proposed LLP as may be prescribed. All right. So this is the information that needs to be submitted at the time of incorporation. I request you to take 30 seconds and read the slide. Okay. If a person makes a statement as discussed above which he knows to be false, does not believe to be true, shall be punishable, which may extend to 2 years, and fine which may not be less than 10,000, but which may extend to rupees 5 lakhs. So in case any of the person making any statement in the LLP incorporation document which he knows to be false, in that case he will be imprisoned with a term which may extend to 2 years, and with a fine which may not be less than rupees 10,000 and extend to rupees 5 lakhs. On registration, the LLP by its name be capable of doing and suffering such other acts and things as body corporates may lawfully do suffer, suing and being sued, having a common seal if it decides to have one, acquiring, owning, and developing, disposing of property. So by doing this, it means that once the LLP comes into incorporation, it can sue and be sued. It can have a common seal if it wants to have one. It is not mandatory, but it is optional. And doing and suffering such other things as body corporates do. So these are the things that happens when an LLP comes into existence. They can own properties in their own name, that will be immovable, movable, or tangible or intangible properties. Those can be held in the name of the LLP. All right. Now let's look at an important concept again. What are the partners and their relations? Save as otherwise provided by the Act, the mutual rights and duties of the partners of an LLP and the mutual rights and duties of the LLP and its partners shall be governed by the LLP agreement between the partners or between the LLP and its partners. Now, please remember, if there are 4 partners in an LLP, the relationship between the 4 partners internally into the LLP, as well as the relationship between the partners and the LLP, will be governed by the terms and conditions given in the LLP agreement. That is the reason why an LLP agreement becomes a document of utmost importance, and it should contain all the documents and all the details. The LLP agreement and any changes, if any, made shall be filed with the registrar in such form, manner accompanied by the friend. Now, when I told you that there is a minimal compliance that is required in an LLP compared to a traditional partnership, here is what it starts. Whenever there is any partner who retires, or whenever there is any partner who's admitted into the firm, in that case, the intimation has to be made to the ROC that this partner has come into the LLP and this partner has left the LLP, by filling up a form and paying the respective fees to the ROC, so that the ROC updates that information in his records and it is updated there. And this is mandatorily required to be done normally within 30 days of any such change. So within 30 days of any such change, the change has to be intimated to the ROC through filling of a form and paying of fees and certification by a practicing professional. An agreement in writing made before the incorporation of an LLP between the persons who will subscribe the names to the incorporation document may impose obligations on the LLP, provided such agreement is ratified by all the partners. Okay, now see, now what happens? Now suddenly the partners have decided, hi Nikhil, welcome to my session. Now partners have decided to start off a LLP. Now they might have an earlier LLP agreement which they were following and they want to continue with that LLP agreement itself. In that case, all the partners have to ratify. When I say ratify, ratify means unanimously agree that the old LLP agreement will continue in the new LLP. In that case, the old agreement will hold good, or they are required to file a new LLP agreement at the time of incorporation. Normally what happens is a new agreement is filed in the while the incorporation of an LLP, and the old one cannot be used. Okay. In the absence of the agreement to any, the mutual rights and duties of the partners and the mutual rights and duties of the LLP and the partners shall be determined by the provisions relating to the matter as set out in the first schedule. Now, please remember, like I told you, the LLP agreement is an important document. It contains all the rules and regulations pertaining to that LLP. But what if there is any matter that is contained in the that is silent in the LLP agreement? Let's say the matter is silent about the admission of a new partner into the LLP. If that topic is silent, then in that case, you need to come back to the provisions of the LLP Act 2008, that is the Limited Liability Partnership Act 2008, and read what does the Act speak about that provision. Now let's take a case where the LLP agreement is silent about something and the LLP Act 2008 is silent about something. In that case, you need to go to the Indian Contracts Act 1872 and see if your problem is solved there. But this is a rare case. Most of your problems will be solved in the LLP agreement because that is the document that you have agreed upon, the partners. And in case something is missed out in the LLP agreement, then you need to go to the first schedule of the Limited Liability Partnership Act 2008, and it will get solved there. Any questions on this slide, please ask me. Anything? Can we proceed? Okay. Now, when does the partnership interest cease to exist? Cessation means cease to exist. A person may cease to be a partner of the LLP in accordance with an agreement with the other partners, or in the absence of an agreement with other partners as to cessation of being a partner, by giving notice of writing of not less than 30 days to the other partners of his intention to resign as a partner. Now, if normally what happens, as per the LLP agreement, if anything happens or does not happen, then a partner can be removed, or a partner may be removed, taken out from the LLP. But in case there is nothing mentioned over there, in such a case, the partner may give his notice, 30 days, at least 30 days notice, that he wants to leave the Limited Liability Partnership firm to the other partners, and then after 30 days, he can leave the partnership firm. Now, the rules and regulations, the procedures is normally set out in the LLP agreement. If the LLP agreement is silent about it, then you again need to go to the first schedule of the Limited Liability Partnership Act 2008. Yes, I hope I'm audible. I'd like to ask my participants, I hope I'm audible. I hope I'm visible. I hope I'm not too fast. If there's anything, please let me know. अगर आप लोगों को कुछ भी समस्या हो रही है कि या तो मैं बहुत फास्ट हूं या ठीक से सुनाई नहीं दे रहा हूं, तो प्लीज बता दीजिए. That will get rectified. Please let me know. Okay. A person shall cease to be a partner of an LLP on his death or dissolution of the LLP if he is declared of unsound mind by a competent court, or if he has applied to be adjudged as an insolvent or declared as an insolvent. Okay, now these are the mandatory cases in which a person ceases to be the partner. The first is he gives a 30 days notice. जी हाँ रितिजा जी, हम हिंदी भी बोलते हैं. Hindi is my mother tongue, but I prefer to speak in English. So the first case is when he voluntarily wants to exit from the limited liability partnership, he gives a 30-day notice. But these are the instances where he is mandatorily required to, or he mandatorily ceases to be a partner in the LLP. Now, what are those cases? On his death or dissolution of the LLP. If he is declared as unsound mind by a competent court, unsound mind means a person who cannot think straight, or a person whose mind is not sound, who's mentally not okay, in order to be a partner or to enter into a contract. And he should be declared so by a competent court. Just by calling someone a mad person or a person of unsound mind, he does not become a person of unsound mind. He should be declared by a competent court to be a person of unsound mind. If he or she has applied to the court to be declared as an insolvent or declared as an insolvent. Now, if a person has filed for bankruptcy or insolvency and the court declares him as an insolvent or bankrupt, in that case, again, he ceases to be a partner simply because he will not be in a position to take financial commitments and responsibilities. All right? Where a person has ceased to be a partner of the LLP, hereinafter referred to as former partner, the former partner is to be regarded as a partner of the LLP unless, so if a person has left the partnership firm or ceases to be a partner, he shall continue to be a partner or continue to be considered as a partner of the LLP until and unless he gives the notice, public notice, that he has left the firm, and he shall not be responsible for the acts of the firm effective so and so date. So please remember, during an admission or during a retirement, I covered this point under the Indian Partnership Act 1932. The retiring partner is liable until he gives a public notice. And similarly here, if any partner leaves the limited liability partnership firm, he shall continue to be liable unless and until he gives a public notice about himself leaving the limited liability partnership firm. Any questions? Please ask me. Okay, now let's go to the important concept of extent and limitation of liability of LLP and partner. The extent of liability of LLP. LLP is not bound by anything done by a partner in dealing with a person if the partner in fact has no authority to act for the LLP in doing a particular act, and the person knows that he has no authority or does not know or believe to him to be a partner of the LLP. Okay, now the topic what we're going to talk about is, in which situations is the LLP not responsible for the acts of the partner? Please remember, we've always kept saying that a partner of an LLP is the agent of the LLP, and he can bind the LLP by his actions, but not the other partners. But this is an exception to the case that the LLP is not bound by the actions of the partner. Now let's take an example of A being a partner in an LLP and C being one of the vendors of LLP. The C sells hardware items. So A approaches C on behalf of the LLP A, B and Co. and tells him that I want to buy so and so material on credit, and I'll repay the money to you in maybe 6 months to 1 year's time. So the LLP will not be responsible if A has purchased the items from C, and the LLP will not be responsible to pay C the money if A had no authority to bind the firm or make purchases on behalf of the firm from C, point number one, and C knew about it, that A has no authority to do so, but still C went ahead and sold the goods to him. In this case, the LLP will not be held responsible to pay the money to C in case things go wrong. And in that case, C will have to recover the money by filing a case on A, not on A, B and Co. LLP. Are you clear? Any questions, please ask me. Okay. The LLP is liable if a partner of an LLP is liable to any person as a result of wrongful act or omission on his part in the course of business or with his authority. Now, if any person is acting within the authority, like I told you, a partner is the agent of an LLP. So if a partner is working within his authority, it's a genuine transaction, and he goes to C and purchases the hardware items worth 5 lakhs. In that case, it was a genuine transaction, everything was okay. Or maybe if A has the authority to buy the goods, but he misuses his authority. He misuses his authority in such a way that he goes and the authority given to him is for 500 items. Or maybe let's say the authority is given to A to buy any goods from C, and he goes and he buys the goods from C. In that case, it was a genuine transaction, even though it may be a wrongful act on behalf of A. But then in that case, the LLP is bound by the actions of A and will have to make good the money to C, because A had the authority to do that and worked much, and he functioned well within his authority. Am I clear? An obligation of the LLP, whether arising in conflict, contract, or otherwise, shall be solely the obligation of the LLP. Like again, we spoke, if the LLP has entered into any contract with any external party, then it becomes the obligation of only the LLP and not of the partners. Like we discussed earlier, LLP is different or separate from its partners. So, the obligation of the LLP is different from the obligation of the partners. The liabilities of the LLP shall be met out of the property of the LLP. Like we told you, once the LLP is incorporated, it has the capacity to enter into contracts, hold assets, that is tangible, intangible, movable, immovable. So the liabilities of the LLP will be met out of those assets. LLP can have a bank account, can hold FDs, can hold investments. So whatever liabilities are there of an LLP, that should be met out of the assets of the LLP. Any questions on this, please ask me. Okay. Now we talk about the extent of liability of a partner. In the previous slide, we spoke about extent of liability of a LLP. A partner is not personally liable directly or indirectly for any obligation referred to in subsection 3 of section 27 solely by reason of being a partner of the LLP. Now, what did we talk about this? We said that if any obligation that is made by the LLP is the obligation of the LLP alone. It is not the obligation or responsibility of the partner. So that is being repeated here again. Please remember, once an LLP comes into existence, the LLP can enter into contracts, can hold assets, can hold liabilities, and because of this, the obligations that the LLP has created will be the obligations of the LLP alone and not of the partners. A partner is not personally liable for those obligations. The provisions of subsection 3 of section 27 and subsection 1 of this section shall not affect the personal liability of partner for his wrongful acts or omission, but a partner shall not be personally liable for the wrongful acts or omission of any other partner. So again, please remember, if there is any partner and who's done any wrongful acts or dishonest acts with relation to the LLP, then he shall be personally liable. But because of the wrongful or dishonest acts of one of the partners, the other partners will not be personally liable. It will only be that partner who has committed those dishonest and wrongful acts. Take about 30 seconds, read the slide and ask me any questions you have. All right, unlimited liability in case of fraud. Now, this is again an exception that we talk about when we say that there is the liability of the partner is limited. Now, in cases the partner has worked in a very fraudulent manner, that if A, being a partner, goes and deals with the vendor C with an intention to carry out a fraud, or if A works with B, that is the other partner, with an intention to carry out a fraud, in such a case, the liability of the partner is unlimited. That means, in such a case, if the matter goes to court, the court can order his personal assets to be seized, captured, and adjusted to recover the debts from him. So let's read it. In the event of an act carried out by an LLP or its partners with the intent to defraud creditors of the LLP or any other person for any fraudulent purpose, the liability of the LLP and partners who acted with intent to defraud creditors or any other fraudulent purpose shall be unlimited for all or any of the debts and liabilities of the LLP. However, in case such an act is carried out by a partner, the LLP is liable to the same extent as the partner unless it is established by the LLP that such act was without the knowledge of the authority of the LLP. Now quickly to explain this to you, if any partner or the LLP carries out a fraud or carries out a fraudulent transaction with an intent to take advantage over another person or the vendors or the creditors of the LLP, in that case, the liability of all the partners will be unlimited. Next, the last point says, carried out by a partner, the LLP shall be liable for the same. So please remember, a partner is the agent of the LLP. Okay, and in that case, if he binds the LLP through a fraudulent act of his, then the LLP will be liable for that act, unless and until the LLP can demonstrate that the partner worked beyond his capacity or authority, or that the LLP did not give him the authority to do so. In such a case, the partner's liability will be unlimited. Are we clear so far? Okay, let's proceed. Where any business is carried out with such intent or for such purpose as mentioned in subsection 1, every person who was knowingly a party to the carrying of the business in the manner aforesaid shall be punishable. Now again, if any person has carried on the transactions fraudulently or with the intent to do it fraudulently, then all the people who were involved in such a fraud will be responsible, and the punishment will be as follows, which may be imprisonment for up to 2 years and fine which may be not less than 50,000 but which may extend to 5 lakhs if the matter reaches the court. Where LLP or any partner or designated partner or LLP or such has conducted the affairs of a LLP in a fraudulent manner, then without prejudice to any criminal proceedings which may arise under the law for the time being in force, the LLP and any such partner or designated partner or employee shall be liable to pay compensation. This is again the legal remedies that are available. If any of the partners carry on a fraud due to which an external party has suffered, then in addition to the above imprisonment and fine which we spoke about, they will also be liable to pay compensation to the aggrieved external party. Now let's go for certain admin matters. Financial disclosure. Every LLP is required to maintain proper books of accounts. The LLP shall maintain such books of accounts as may be prescribed relating to the affairs of each year in its existence on cash basis or accrual basis according to double entry system, shall maintain the same at the register office for each period as may be prescribed. Normally, what is the financial year for a LLP or a company? It's from starting from 1st April and ending on 31st March of the following year. So these are the proper books of accounts that each LLP is required to maintain about its affairs for each year of existence. That means sales book, purchase book, expense book, cash book it's supposed to maintain. They can either maintain it on cash basis or accrual basis. Normally, no one these days maintains it on cash basis. It is all done on accrual basis. Accrual basis of accounting is a system of accounting wherein you anticipate your losses and book your gains. So it is a way of accounting in which you estimate or assume certain things and book your gains, book your entries. Double entry system of accounting. What does double entry system of accounting mean? Double entry system of accounting simply means one single journal entry will appear in two places, in two ledgers. That is double entry system of accounting. Single entry system of accounting is not prevalent in India. In India, all business firms follow double entry system of accounting, and all these records have to be maintained in the registered office of the LLP and for each year. Statement of account and insolvency. Every year when the financial year gets over, let's say for 1st April 2019 to 31st March 2020, they need to file a statement of solvency, that is Form 8 and Form 11 with the MCA and ROC with all the details that are required in the form. The form contains a lot of details like your P&L account, balance sheet, your change in partners and everything. So all those things have to be filed within 6 months from the end of the financial year with the ROC. Winding up and dissolution. This will be the concluding part of our chapter. Winding up and dissolution. The winding up of an LLP may either be voluntary or by tribunal, and so wound up may be dissolved. Like I told you, an LLP can be dissolved either by voluntary applying for dissolution or when you apply to the tribunal to get it dissolved due to certain matters. Circumstances in which an LLP may be wound up by the tribunal. An LLP may be wound up by the tribunal if the LLP decides the LLP be wound up by the tribunal. If the partners decide that they no longer want to work and they want the LLP to be dissolved, then they can apply to the tribunal. If for a period of more than 6 months, the number of partners of an LLP is reduced below 2. Like I said, the minimum number of partners in an LLP is 2. So if the number of partners have reduced below 2 for a continuous period of 6 months for LLP, then you can apply to the tribunal to wind up that LLP. If the LLP is unable to pay its debts, if the LLP has bought materials from a vendor and it's unable to pay its debts, in that case, the vendor can apply to the tribunal for winding up of the LLP. If the LLP has acted against the interest of the sovereignty of integrity of India, please remember, if any LLP is created for a unlawful purpose, and if that purpose is against the security and sovereignty of the country of India, in that case, the tribunal can order for the LLP to be wound up. If the LLP has made a default in filing with the registrar a statement of account insolvency for consecutive 5 years, like I said, at the end of each financial year, it's supposed to file a statement of solvency. And if for 5 continuous years it does not file these statements with the ROC, then the ROC can apply to the tribunal for the company to be wound up. If the tribunal is of the opinion if there are any other reasons that the tribunal thinks that the LLP should be wound up, in that case, it can order for its winding up. Rules for winding up and dissolution, the central government may make rules. All right. Now let's quickly look at this. The differences with other forms of organization. What are the differences with other forms of organization? Firstly, let's look at LLP and a traditional partnership firm. An LLP is governed by the Limited Liability Partnership Act 2008, whereas the traditional partnership is governed by the Indian Partnership Act 1932. Body corporate. The LLP is a body corporate, whereas a partnership firm is not a body corporate. Separate legal identity. It is a separate legal identity. Okay, LLP, like I said, is a separate legal entity, whereas a partnership firm is not a separate legal entity and is represented by its partners. Creation. It is created by the process. LLP is created by the process of incorporation under the LLP Act 2008. Whereas traditional partnership is created under the Indian Partnership Act 1932, where it does not have any such regulated process. Registration is mandatory. LLP can sue and be sued on its own, whereas a registration for a traditional partnership is not mandatory. We had covered this topic yesterday. So registration of a traditional partnership is optional, and unless and until it gets registered, it cannot sue or be sued. It can be sued, but it cannot sue an outside party or the partners. Then let's look at the difference between an LLP and a private limited company. An LLP is governed by the Limited Liability Partnership Act, whereas a private limited company is governed by the Companies Act 2013. The LLP members or partners who contribute to the LLP are known as partners. So the people who come to form the LLP are known as partners, whereas the people in the company are known as shareholders or directors. There is no partners. The internal corporate governance structure, the agreement between the parties. Now, like I said, LLP agreement is the most important document, and your internal governance structure is governed by the LLP or the LLP agreement, whereas the internal governance structure of a private limited company is governed by the Articles of Association of the company and the Companies Act 2013. Number of members and partners. LLP, the minimum number of partners in a LLP is 2, and the maximum number is no limit. Whereas in a private limited company, the minimum number of directors is 2, and the maximum number is 50. Whereas in a public limited company, it is 7, and there is no limit on the maximum number. So here, if we actually go through this slide, we will get to know what the differences between LLP and a private limited company are. Just take about 20-30 seconds, go through this slide, and we will conclude with the chapter on Limited Liability Partnership Act 2008, Part 2, and we shall continue with the Companies Act 2013 going forward. Thank you so much. I hope you enjoyed and understood the session on Limited Liability Partnership Act Part 2. The Part 1 was done yesterday. Please do not forget to use the code Prathik, Prathik, while you make your Unacademy subscriptions. Thank you so much, and see you around in the next sessions.